Okay, I'm back. So now I'm back as Craig, CIO. Craig, the co-founder earlier. And really what I want to talk about is kind of set the foundation or kind of set the scene for the rest of this evening. It's an investment conference. As I mentioned, in 2019, we got our asset management license. We launched several model portfolios in 2019. And what that did was it really brought about structure to our investment philosophy. So our investment philosophy had been working quite well in our first 10 years. It's the reason that we managed to grow through fairly difficult times, and it's the reason that we managed to attract the clients that we did. So we launched our funds in 29, and one of the questions we've had a lot over the last 3 years in particular, because our model portfolios grew to a size where we could then convert them to funds. There's a lot of our clients and there's a lot of debate in the market about why a financial planning firm would have its own funds in the first place. So just to tackle that question head on, because we don't shy away from the difficult questions, we prefer to tackle them head on. So firstly, it's, as I mentioned, it's a structured execution of our investment philosophy. So we've taken it, we've written it down, it's always been written down, but in kind of codified it and made sure that it's, kind of tested it with our DFM, discretionary fund manager firm that we use to help us run the funds. And that, as the business was growing, meant that we had a much stronger control over our investment philosophy, that we could take that investment philosophy and roll it out. It's no longer just Kagisho, Virat and myself in the business. We had Vainant, we had Munaf, we had other advisors joining. And so it brought about that control. From a client perspective, it helped us to mitigate capital gains, which I think is quite an important benefit to clients, particularly high net worth clients, because we could execute through the fund, and through that process, we're not triggering capital gains every time we need to either change the asset allocation or change in a fund manager. Quite important, it also gave clients access to a broader range of funds. So inside our funds, we were able to access funds that clients cannot access themselves. So particularly on the offshore side, from an offshore perspective, South African clients are limited to Section 65 approved funds. However, our funds are not limited to Section 65, so we could bring a bit more to clients, and through that process, add value to our clients. And then lastly, we were able to do this while maintaining a cost that's in the cheapest quartile within the different sectors that our funds operate. So we were able to squeeze out costs and deliver proper value to our clients. The performance surveys came out yesterday for the end of Feb. Our growth fund, our moderate fund, as well as our cautious fund. Those were the first 3 funds we launched. Over 2 years, all those funds are in the top 10 in their relative categories. Over 2 years, they were in the top 5. Over 3 years, they were in the top 10 in their categories. So the growth fund, top 10 out of over 220 funds. Our moderate fund was ranked 3rd out of over 120 funds. So thank you. So that philosophy that, when you launch your own funds, if you're not quite sure about the philosophy and what you're doing is right, you can get shown up quite badly, because your homework gets marked very publicly, because everybody has access to those performance reports. So that's why we have the funds. And to give you a sense of the funds that we've got the GM Cautious, Moderate, and Growth. As I mentioned, those are our Regulation 28 compliant funds. Those are the funds that you put retirement money into, or at least they meet the requirements for retirement money. We launched the Worldwide Fund in February. So the Worldwide Fund, we've run it as a model since 2019. Since 2019, it's delivered 12.7% net of fees per annum since 2019, and we've grown it to a size where we can now convert it to a fund. The Global Balance, the GMI Global Balance Fund, the dollar-denominated fund we launched 2 weeks ago. So I was in Mauritius, 2 weeks ago, for the final kind of scoping of the fund and for the sign-off to launch the fund. And that fund is now gone live. It's available on the Ellen Gray platform and will be on OMI pretty soon. I think the Old Mutual people, it'd be. So again, the reason we're running the fund out of Mauritius, again, is so that we can access funds that we can't access if we were to run the fund from South Africa. So, I mean, some of the funds in there, for example, PIMCO is the largest fixed interest manager in the world. They're not Section 65 approved. PACER, and then also some of the index tracking funds. You know, if you buy the MSCI World in South Africa, it'll cost you 0.4, 0.5%. From Mauritius, we can access it at less than 0.1 for our clients. So it makes the flight worthwhile. And it certainly makes all that effort worthwhile for clients as well. So I'm sure your advisor will be speaking to you about that. But I think this is pretty much where we focus a lot of our time and effort. And in fact, the investment conference tonight hopefully will give you a sense of how we arrive at kind of the asset allocation. So the actual numbers are not important. It's just to give you a sense that our portfolios are all diversified. They're well diversified. They are structured to meet the needs of our clients. So we're quite clear about which solution is for which clients and that the asset allocation follows through. So when you listen to our speakers tonight, pretty much the way we've designed the program is how we run our investment committee meetings. So we start off with the big picture, understand what's happening in the world from an economic perspective, and then try and interpret what that means from an asset allocation perspective. What we don't do is change that picture too drastically, too often. So we spent a lot of time when we set up the funds to get the high-level asset allocation, and then on an ongoing basis, it's really about refining that and making sure it's still relevant. And then this gives you a sense of who the underlying fund managers are in our portfolio. So on the fixed interest side, you know a lot of those names, but some of the names that you perhaps don't have access to directly, JP Morgan, BlackRock. Very few people know Terebrinth. Have any of you heard of Terebrinth? Any of you who's not in the industry heard of Terebrinth? So fixed interest manager based up a few kilometers from here. Fantastic track record and a very niche manager that very few people know about outside of the industry. On the listed property side, most people know 91 and Catalyst and Coronation. Very few people have heard of Catalyst. Now owned by Sanlam, but for many years an independent niche property manager. And then on the equity side, 361, you're going to hear from Zandile just now from 361. One of the core managers in our portfolios, one of the managers that have been delivering excellent returns for our clients, and one of the managers that have been contributing to the performance that you've seen. But then again, anyone heard of Artisan Asset Management? Probably not. Fundsmith, one of the biggest equity funds in the UK. Sands Capital, running out of Washington. So the process of selecting the fund managers that process, we've spent a lot of time getting to know the managers, getting to understand their philosophy, and then how to put them together as a team. So we've done our bit. The fund managers have been doing their bit. What we need is for you to do your bit. Okay, because investing isn't about picking the best performers. It's about finding managers with three things: an edge, repeatability, and temperament. Okay, when Donald Trump opens his mouth, if fund manager's panicking, it's not a fund manager that we'd like to have in our portfolio. Okay, but it goes on and says there is a catch. Your success in allocating to funds isn't just about the manager. It's about you too. Even the best fund in the world won't work for you if you can't handle its behavior. So before you start screening on performance, ask yourself, does the manager and do I, as the investor, have a repeatable edge with the temperament to stick to it? And that's a quote from Lucy Walker, who's the founder of AM Insights and chair of the Aurora Investment Trust. Okay, so we can find you the best funds. Screening for performance is the easiest thing to do. Very often, the reason people don't achieve their investment objectives is behavior. Okay, so the reason we go through the effort of putting an investment conference together and inviting clients to that is that we're hoping that over time that we can help clients work on the behavioral side of it, because with better understanding comes the better behavior that's needed for investment success. So on that note, I'm going to ask Munaf to introduce our two speakers, Isak and Zandile, and then I'll be back a bit later. Thank you.